95% of stock pickers fail to beat the market in the long run. So if the full-time pros can't beat the market, what chance does the average investor have? Today we're looking at the active versus passive investing debate through the lens of the SPIVA Scorecard, an independent report from S&P to explain why more investors are turning to passive investing and what that means for your portfolio. I'm James Bashall from NerdWallet Wealth Partners, and today we'll break down what active and passive investing are, see which performs better, and discuss what that means for long-term investors. All right, let's dive in. What is active investing? Active investing is when you pay a professional, usually through a mutual fund or ETF, to try to beat the market. They pick stocks or time trades to try outperform the market, which is called earning alpha. Passive investing, on the other hand, is about owning the whole market, like proportionately buying every stock in the S&P 500 and just holding on. The goal isn't to outperform the market, but to match it, usually with lower fees, less trading, and fewer tax headaches. Active investing has been around for roughly a century, while passive investing really took off in the 1970s, when index funds made it easy for anyone to essentially buy the entire market at once. At first, investors were skeptical, but index funds kept proving themselves and adoption grew quickly. So that's the background, but here's the big question. Which one actually performs better? Twice a year, SPIVA, which stands for S&P Indices Versus Active, releases a report called the SPIVA Scorecard that basically asks, are professional fund managers actually beating the market? To make that comparison fair, SPIVA matches each fund against the market index that represents the type of companies it invests in. For example, large cap, mid cap, or small cap indices. Large caps are the biggest companies. Mid caps are mid-sized firms that are still growing, and small caps are smaller, high-risk companies with bigger growth potential. SPIVA then analyzes how each group of active funds performed against its matching index. That's the scorecard that shows whether active managers, in practice, are beating or trailing the market they're trying to outperform. What do the results show? Let's take a look at the most recent SPIVA report as of mid-year 2025. You see that over the past decade, most active managers didn't beat the market they were aiming to outperform. And in fact, the longer you stretch the time frame, the harder it gets. After 20 years, roughly 9 out of 10 funds in every category trailed their benchmarks. This is particularly relevant for long-term investors, whose investment horizon is often beyond 20 years. Even in small cap funds, where managers are often thought to have more opportunity, the majority still fell short. Across every size category, the odds of consistently beating the market shrink dramatically over time. So at this point, you might be thinking, okay, maybe some active funds do a little better. Does that count? That's where risk-adjusted performance comes in. It's not just about how much a fund earns, but how it earns it, meaning how much risk or volatility it takes along the way. If you want to learn more about how NerdWallet Wealth Partners approaches passive investing, click the link in the description to connect with us. When analysts calculate risk-adjusted returns, they look at how steady a fund's results are, whether it goes smoothly or if it bounces around with big ups and downs. Here's why that matters. First, steady returns make it easier to stay invested. When a fund swings wildly, investors are more likely to panic and sell at the wrong time. Passive funds, which move in line with the broader market, tend to feel more predictable, helping people stick with their plans through market cycles. Second, smooth performance may lead to better compound returns over time. If your portfolio drops 30%, it then needs a gain of more than 40% just to break even. Lower volatility helps reduce those setbacks, which can make a real difference in the long term. So when we adjust returns for risk, we're actually asking, did this fund perform well because it was efficient or because it took on more ups and downs to get there? When SPIVA looked at that, the results were striking. Over 10 years, about 95% of active US funds underperformed their benchmarks once risk was taken into account. In plain terms, even when active funds had bigger wins in some years, those gains often came with more stress and larger losses. When you smooth out that ride, passive funds, which aim to match a market index, tend to come out ahead. So what do we take away from all this? When you look at decades of data, passive investing, buying and holding diversified index funds, has historically outperformed active approaches, especially after accounting for fees, taxes, and volatility. Passive investing isn't perfect. You'll mirror the market's highs and lows, you can't easily sidestep weak sectors, and you have to stay patient when volatility hits. Active investing can work, but predicting who will beat the market and when is incredibly tough. Even full-time professionals with all the tools rarely outperform simple index investing. This reinforces that success in investing often comes from consistency, discipline, and a long-term plan. For most investors with a 10, 20, or even 30-year horizon, focusing on diversification, minimizing costs, and staying invested typically leads to more consistent long-term outcomes. Remember, we're not trying to make the most money by taking high risks. We're trying to make enough money to achieve our goals by taking as little risk as possible to get there. At NerdWallet Wealth Partners, that's how we approach portfolio design, building passive strategies around your goals, risk tolerance, and time horizon, without betting on market timing, stock picking, or manager luck. If you'd like to explore whether our team is a good fit to help you create a clear, evidence-based investment plan, visit the link below to learn more about NerdWallet Wealth Partners. And if you found this video helpful, hit subscribe so you stay in the know.